Have you ever really wondered how a professional trader actually sees the market? It's not just about watching prices flash on a screen. Not at all. It's about building a structured, disciplined way of thinking, a framework to make sense of all that chaos. In this explainer, we're going to peel back the curtain and break down exactly how they build that powerful market view, piece by piece.
Right off the bat, we have to get one thing straight, and this is a huge mental shift for a lot of people. The goal is not to be certain. It's not about predicting the future. As the source material says so well, seeking certainty is a psychological trap. It just leads to overconfidence and, some really big losses. The key thing to remember is that professionals don't predict, they prepare.
So here's our roadmap. We're going to start by really defining what a market view is. Then we'll look at the raw material, the data. After that, we'll dive into the 3 critical lenses that pros use to see the market clearly. And finally, we'll pull it all together in the synthesis.
So our first stop is all about getting past this idea of making simple forecasts. This isn't about finding a crystal ball. It's about building a robust framework for how you think.
I absolutely love this definition. A market view isn't a prediction. It's a probabilistic map. Think about that. It's not a single destination you're trying to guess, it's the entire map itself. It shows you all the possible roads, where the mountains are, where the swamps are. It's a tool built to help you navigate uncertainty, not to pretend that it doesn't exist.
And this slide just lays out that mental shift perfectly. The amateur is desperately looking for that sure thing, right? And they get thrown around by every single headline. But the professional? They're busy building that probabilistic map, staying humble and focusing only on what really matters, finding the signal inside all of that noise. All right, let's talk about the raw material for any of this, data. But here's the twist that trips so many people up. Just collecting more and more data is a classic rookie mistake. What really matters isn't how many spreadsheets you have, it's the quality of how you interpret that data. A professional looks at every single data point with a healthy dose of skepticism. They know that what they're seeing, like say an initial jobs report, is almost always an imperfect, partial snapshot of reality. That data is going to get revised, the definitions might change, nothing is ever as clean as it looks on a web page. And because of that, this step is absolutely critical. Before any real analysis can even begin, that raw data has to pass through a really tough processing filter. This means cleaning it up, adjusting for stuff like seasonality, and getting rid of any weird one-off distortions. The real work only begins after all of that is done.
Okay, let's grab our first analytical tool. This is the fundamental lens, and this is all about understanding the real-world economic stuff, the nuts and bolts of supply and demand. It's about getting to the core why of the market.
And really, this is the single most important question that fundamental analysis tries to answer. It forces you to look past the squiggly lines on a chart and identify the actual, tangible reasons, the real drivers that could make something more or less valuable. So, to answer that big why, we first have to figure out the dominant driver. Is this a supply story or a demand story right now? From there, we look at inventories. Seriously, think of inventory as the market's shock absorber. When inventory is super low, even a tiny disruption to supply or demand can cause a massive swing in price. It's such a critical piece of the puzzle.
Okay, so now we have our fundamental story. But here's the thing, a story without context is dangerous. And that's where our second lens, quantitative analysis, comes into play. It gives us that objective statistical backdrop.
And this is its guiding question. Is this price move, this level of inventory, or whatever it is we're looking at, is it actually unusual, or does it just kind of feel that way? Our brains are just terrible at judging scale and probability on their own, so we need tools to cut through that bias. The professional's go-to tool for this is something called the Z-score. It's a super simple but incredibly powerful way to measure how far away something is from its average in standardized units. So instead of just saying a price feels high, a pro can say, with precision, it's 2 standard deviations above its 5-year average. It's the difference between saying it's hot outside and saying it's 95 degrees. It replaces a vague feeling with a hard fact.
And just look at this example right here. Seeing the average price next to today's price, well, that's one thing. But knowing that today's price is a +2 Z-score event, that tells you instantly that you're in statistically rare territory. It's an objective flag that basically screams, hey, pay attention, this is not a normal day.
And that brings us to our third and final lens, the execution view.
This is where we take our fundamental story and our statistical context and ground them in the hard reality of what is happening in the market, right here, right now.
Because no matter how brilliant your theory is, the market is the ultimate judge. This lens is all about reading the tape, understanding the flow, the behavior of other traders, and the real conviction behind a price move. Theory is great, but at the end of the day, cash is king. So how do we actually read the tape? Well, first, we look at the market structure. Where are the big clusters of buy and sell orders? Second, and this is huge, we watch the market's reaction. If really bearish news comes out and the price just doesn't drop, that tells you something incredibly powerful about the underlying strength. And finally, you watch the volume. A price move on high volumes shows real conviction.
And now we bring it all together. The real magic, the core of professional analysis, isn't about mastering just one of these lenses. It's about combining all three to create a robust, triangulated view of the world.
You know, as this slide shows, if you rely on just one lens, you're going to fall into predictable traps. A purely fundamental trader, they get caught in value traps, where something that looks cheap just keeps getting cheaper. The quant analyst, they get blindsided when the underlying structure of the market suddenly changes. And the price action trader, they just end up chasing random noise instead of a real structural move.
This right here is the entire goal of the framework. You are looking for alignment. You're hunting for those rare but incredibly powerful moments when the fundamental story, the statistical context, and the real-time price action all point in the exact same direction. And here's what that alignment looks like in the real world. Number 1, your fundamental lens tells you inventories are critically low. Number 2, your quantitative lens shows the price is statistically very cheap compared to its own history. And number 3, your price action lens sees the market breaking out with a huge surge in volume. Now that is a high conviction setup.
So you can think of this whole framework as a shield, where each lens protects you from a specific type of risk. Your fundamental analysis reduces your thematic risk, making sure your big idea actually makes economic sense. The quant lens reduces your statistical risk, so you don't misjudge how extreme a move really is. And the price action lens? It reduces your execution risk, keeping you from jumping into a great idea at a terrible time.
So a market view isn't just an opinion. It's a structured thesis built on these three distinct realities: the economic, the statistical, and the execution. It transforms you from just a passive observer into an active interpreter of the market. And the only question left is, where are you going to start looking for that alignment?